So today's session is primarily on trading psychology and risk management. I know most of the folks underestimate or ignore these two important aspects in trading. I believe they contribute more than 50% towards the success in stock market. And hence I took this opportunity to basically share what I have learned over years regarding trading psychology and risk management. At the end of this session, I hope I'm able to do justice to your time and able to impart some of the trading aspects, which I think is very important for your success in trading over a long term. We all know that these things are very important, but in actual, we are not able to apply it all or every time. And if we do, I'm pretty sure most of us here would have a very successful trading career. So we'll take questions as we go. And in the end, I'll probably leave some time for general questions, not just related to these two topics, but anything in general. And I'm anyways recording this session, so feel free to look at it afterwards. I'll share the link once it's uploaded. Cool. Okay, let's get started. First of all, disclaimer, the following content is only for casual learning in a non-professional setting. Please consult your tax, financial, or legal advisor before entering any investment. I am neither of the above. Agenda, as we already discussed, trading psychology, risk management. At the end of the session, I'll leave some time for Q&A. All right, let's directly jump into the slides. Trading psychology. So I've tried to list down a bunch of points, bunch of experience points, which I've gained over years. I've tried to list down in these slides. So this is totally different than the previous session, which we had on technical analysis. So this one doesn't have any charts or anything of that sort. This is primarily my experience just written down in a few paragraphs. I'll try to speak through most of them and try to make you guys understand what exactly each of the sentence means. So I can definitely take questions after each slide if you have any. So feel free to speak up as soon as I'm done with one slide. Cool. That being said, trading psychology. Wait for setups, don't chase, let the stock come to you instead of jumping in on a trade due to FOMO. FOMO is nothing but fear of missing out. Most of us have been in this position where we feel that, okay, a stock is going up, we need to jump in, otherwise we are going to miss the train and it's going to go up forever. Never do that. Just wait for your setup and never chase. This is something which I've learned. This is a very hard learned experience, and I am guilty of doing it over and over again. But now that thing has been limited by a lot. Secondly, there is always another stock somewhere. The one you missed is not the only one that was going to work out for you. So always think wherever you are feeling the FOMO, just think about this, that was not the only stock which is going to make you a millionaire. There are always hundreds and thousands of stocks somewhere else, and it's just about curtailing your feeling at that time. So controlling the greed. What's gone is gone. Don't keep looking at it. Chances are high that you are going to give it all back. Consider this scenario. You're in a position, you sold it for a good profit. The position keeps on moving up and you're constantly watching it. Now, instead of watching for a meaningful pullback, you jump right back in, and immediately after the stock moves back down. Now you're almost about to give away all your gains. Instead of selling for some minor profit, you still keep the position because you at least want to get back the initial profit. Eventually you end up taking a loss, probably a big one. Now, I'm pretty sure I have done that a lot of times. I'm pretty sure most of you would have faced a similar situation one or the other time during your trading career. And this is something we all have faced. So how do we control the greed? If you're in a position which you've already sold for a good profit, never, ever just jump right back in thinking that you're going to gain most of the time. Chances are that it's going to pull back and you're going to give up on the initial gain. At that time, it's best to step away or wait for a meaningful pullback and never let the FOMO set in. So learning here would be no FOMO. Any profit is definitely a profit. Step away to reduce the urge to get back in. Once you are in profit, never let it go for a loss. Now, just the last sentence, once you are in profit, never let that position go for a loss. If you just go by this, I'm pretty sure you'll do very well in your trading career, because we often let our profits turn sour by selling it at a loss just due to the fact that we are being greedy. If you curtail this feeling, if you always think in the terms, if you are in profit and you don't want to sell a position for a loss, then that's half the job done. Okay. Any questions on these few points? Okay, let's move on. Trading psychology continued. Don't try and time a bottom. Stock is cheap for a reason, as no one wants it. If it changes, you'll have ample of time to get in. We try to, I get this question constantly that, okay, XYZ stock has been beaten down a lot. Is it time to get in? Classic example is Boeing some time back, and all the airline stocks some time ago. We don't know how much is it going to fall. We don't know if a company is going bankrupt tomorrow or not. Of course, it sounds lucrative that it has been beaten down a lot. If you get in now, you're going to, it's a bargain price, but we don't know how much down will it go. So it's best to wait for some days and to see if things are changing. You'll get ample of time to get in. You don't have to actually time a bottom. Look for stocks breaking higher. Don't think that it's too high and cannot go higher. This is one tip which I want to give to you guys. I drastically improved my results after starting to play breakouts instead of bottom fishing. Even now, when I interact with most of my friends or family, they think that, okay, XYZ stock have gone a lot up. It cannot go higher from here. And that's alarming to see, because strength begets strength. If you think that if something is showing strength, that's where you want your eyes or your attention to be, rather than in the weakness. That because blue sky breakouts, which is basically breaking out of all-time high, we don't know what's the potential. Just look at Tesla, for example, Apple, all these stocks where it just doubled, tripled, and there is no stopping to it. And that's why it's best to play breakouts instead of bottom fishing, because we don't know when the bottom is in. So the next point, which is leading up from the previous one, trend is your friend. Ride the wave instead of swimming against it. So if a trend, if the long term, so similarly, look for longs when market is bullish, look for shorts in a bearish market. Limit counter trend moves. I know most of us here are aware of this fact that you need to ride the trend and just ride the wave instead of swimming against it. But very few of us actually apply this in this market. Let's say during March, when the markets were showing bearish character, most of us would have thought, okay, the stock is very much down. Let's basically get in for a long. At that time, our thinking should have been that let's look for a very good risk reward in a short. How do you short, or how do you buy puts? That feeling or that thinking should have been on your mind, instead of looking for a bullish position at that time when the markets were clearly bearish. Similarly, right now, we should be looking for longs when the market is showing bullish character. I know still many of us feel that market have gone so much up, it has to turn down. Don't bet on feelings. Just look what is in front of you and bet on your process. Basically, this point, remove bias, news, tips, your feeling before entering a trade. Trust your setup and trade based on that and only that. I teach technical analysis because I feel that clearly gives you an entry point and clearly defines your exit point. You're not trading based on the feeling, okay, this stock has XYZ PE ratio. Now this is looking lucrative. Let me get in. It's technical analysis tells you all the points you need to know when to get in or when to get out. If your setup is invalid, you just get out. And if your setup is there, you just take the trade. So it removes bias. Just try to remove bias from your trading. Coming into a trading day, if I've heard on CNBC, today is going to be a very bearish day. If I have that in back of my mind, I'm never going to take a trade which shows me bullish character, and I don't want that. If something is in front of me, I just want to trade that. I don't want my mind to be driven by news or driven by any tips or my feeling. That's the reason I don't try to watch all the news. Of course, I do try to follow what's going on, But the news, you can see everything in the price. You don't have to follow the news to know what's going to happen next. More often than not, the news is after the fact. Once the news is published, everybody is already aware of that, and the trade is almost already done. So if you just look at your setups and trade based on that, you'll know when it's going against you, you'll stop out. If it's going with you, you'll just keep booking profits. So it should be as simple as that. Just remove bias and see how your trading might improve. Don't watch anyone else's profit or loss and get carried away. Everyone has different risk appetite and personalities. You don't know anything about that person's background or financial background, how much loss has that person faced previously, or how much success, or what's the backing. You don't know anything. So don't just get carried away with anyone showing profit on Twitter or any other social platform, because you are different. Everybody is different. So the last point here on this slide, don't ever get complacent, as markets will find a way to humble you. So this happens even to me right now. Like if you are having a very good streak, 3 to 5 days of very good movements, 3 to 5 days of good profits, everything going in your favor, never try and overbet or feel that now I've learned the market, I can never go down. The very next day, markets will reverse in a way where all the profits earned in the previous 3 days would go into the drain. So never feel that, yes, you've gained everything what it takes to be successful at markets. Always be a student. Never think that you've known everything, and never, ever think that you are going to be successful in a way where you can just blindly trade. You have to follow the system, is what I'm trying to say here. So any question on these points until now?
Quick question. So you referred to setup in multiple points. So can you explain what that setup means?
Which one?
No, like in multiple points, like you mentioned, like trust your setup, wait for the setup.
Got it. Yeah.
Things like that, right? So
good question. So everybody's setup would be different here. It depends on if you are a trader, investor, if you are a day trader versus a swing trader. So everybody will have a different setup. I have one slide where I discuss that you need to own your setup, or you need to have a setup. For an example, my day trading setup tells me, okay, I will enter. This is just a rough example of what I mean by a setup. I'll enter when there is a touch on the VWAP bounce. So only when I see a VWAP bounce, I'm going to get in. I'm not going to get in if there is a gap up and if a stock is showing bullish character. I'll limit my trading to only the stocks which are just bouncing off of VWAP. That's a setup per se. So don't due to FOMO, don't just enter blindly. Okay, this stock, Apple, for example, it just ran out of the gate a few days ago. It never tested VWAP even for 5 minutes or any time ever. It just shot up and up. So at that time, your setup says that you are only going to trade based on VWAP. So you are going to look for stocks which are testing VWAP. You will just ignore Apple, and you're not going to enter Apple just for the fact that it's just running up, because you never know, as soon as you get in, it will get down. So what I mean by following your setup is, if you're defining some rules, like VWAP bounce is your play, you just play that setup. You are going to ignore the rest. That's what I mean by following your setup. Now, everybody's setup will be different. We can discuss what is my setup exactly, probably in the next session. But what I mean by setup is, whatever you define your trading rules, just follow those. And everybody will have their different trading rules based on their risk appetite. Does that address your question?
Yeah, thank you.
Cool. All right. Next one. Yeah, this one is very important. Cutting losses early, accepting losses, they are the cost of doing this business. Very few of us realize that. Very few of us are happy by cutting losses. Of course, nobody is happy if they're encountering losses. But what we don't realize is, if we don't cut our losses early, they're going to hurt us in a very bad way. This is everybody's aware of this, but it's incredibly hard to follow. What it does is, if you cut your loss early, it saves your capital for future use. Let's say Apple, You put a stop, if you buy at 110, this is just a random example. Apple, you're buying it at 110, your stop loss was 100, you didn't respect your stop loss and you're not accepting loss. You that Apple then falls to 80, 70, 60, your capital is still there. You can't use that capital for anything else. Now, at the end of that decline, this Apple stock was worth $20 less, let's say. You've been from 110 to $20 without accepting loss. If you would have accepted that loss at 100, you would have saved your capital for future use. You wouldn't have drained you up mentally, because uh, any day if we are experiencing loss, I think that's human nature. We'll keep looking at it with the hope that yes, there is some news, there something comes up, and it just shoots up. That's what we then go into the hope mode, and that's something which we want to avoid as a trader. And that's the trading psychology, that you don't ever want to go in a hope mode, because you're not trading, or you're not gambling here. You're trading based on some rules which you have defined, and if you follow the rules, that will make you successful in the long run. So cutting losses early or accepting loss is a very big aspect of trading, which very few folks follow. A fact is, I believe most of us are already aware of this. If in loss, instead of cutting it, it eventually becomes our long-term holding, and we find ways of justifying being in that position. Classic example is Disney or Apple or Netflix. If there is a loss, we feel, okay, it's good for my long-term holding. I'm going to keep it forever and basically retire on that. That should not be the criteria. Whenever you get in a trade, you should know your stop loss. It's as simple as that. If that stop loss is 20 points, 30 points, 40 points down, that's still okay. But you should define your stop loss, that if a price goes below this, you will be getting out of that forever. Not forever, as in at that point in time. This leads to our next section, which is always respect your stops. There can be two types of stops, mental and hard stops. So mental stop is, Apple is trading at let's say 450, and mentally you decide, okay, if Apple trades at 420, I'll be getting out of that position. You don't actually put in your trading system. You can actually decide on a mental stop, but I would suggest, if you have a bit of experience and can constantly watch markets, that's when you put a mental stop. Otherwise, for all the other sections, I would say put a hard stop. Primary reason being, you don't know, if you're not able to watch the market constantly, you don't know if there is a news, if there is a flash crash. That will prevent you from all these situations. You want your capital to be preserved at all the times. You don't want to just leave this Apple bought at 450, and if it goes below 420, you don't want to be in that, because we don't know from 420 even if it's going to 300 or if it's going to bounce up to 500. But what we know is we want to control our losses so that we have enough capital at the end of the day to invest if something is looking lucrative or if something is at a bargain. So that's what I mean by mental and hard stops. I do get a lot of messages from folks saying that they miss their stop loss due to being distracted, and if it's still a good time to hold a position or not. I know a lot of us face this question or face this position, but at that time, I honestly think that you should have your if you're not able to watch, you should just put a hard stop in your trading platform and do whatever you want. It's basically a no op. If you have hard stop, you'll be stopped out as soon as the market trades at that level. Somewhere deep down, even though the position is going down, we don't want to get stopped out. There was a reason why you enter into that position. If that reason is no more, then why do you want to remain? This is just to take a minute to digest this. Okay, so you went in a position, let's say, coming back to the same example of VWAP, I want to enter if there is a VWAP test. So I took a position when there was a VWAP test. I put a stop loss just below the VWAP so that whenever it comes down, I'll be stopped out if it's not going in my favor. Now it comes down and I'm not stopping myself out. The first reason of me being in that position was the VWAP test. Now, if it has gone down, there is no VWAP test. There is no criteria because of which I should still be in that trade. And if I don't have that trading system, or if I don't have that criteria still enabled, I don't want to be in that position. So it's as simple as that. If you are entering a position based on a criteria, and if that criteria is not met, when you're stopping out, you should just stop out. There is no reason to be in that trade forever. Cool. Any questions on that?
Yes, Sarthak, I have a twofold question, I would say, or two scenarios would like to touch base.
Yeah.
For any trade, basically, when you post, you have an entry point and then have a stop loss.
Mhm.
Few times, maybe by the time anyone, or I can say for me, I look at the alert and try to search for or look for the price. It is already too high.
Mhm.
Whatever. I mean, you entered at 150, it could be 170 already.
Yeah.
So at times, it's not a good idea to chase, but is it okay to have a bid set at 150 with the hope it will come down, or just sort of ignore that because it's already moved too high?
Yeah,
That's
yeah, that's a very good question. So I get that a lot, as in whenever I post an alert, it has already moved, or it basically from the time you put in your system, it has moved a lot. So the way I trade is mostly breakout trades, and that's
Mhm,
why as soon as there is action, not just us, but millions of folks are watching that same level, and that's
true.
where there is an action, and basically the price just moves up. So at that time, I will advise to use your best judgment, as in you should not chase, first of all, as I mentioned in the previous slide.
Mhm,
So if I'm
mhm,
entering at 150, I would not recommend you guys to enter at 170. You should it's better to wait for my point. Now, that being said, if it's coming down at 150, you can still enter, because based on the criteria which I entered. Now, of course, you're not watching how I'm trading. If I'm entering at a VWAP bounce, let's say the VWAP was at 150 when I entered. Now, at the next time, VWAP was raised to 160. So at that time, 160 would have been a better position rather than entering at a point where I have entered. So
mhm.
even if you want to enter at my position, I would say then put a stop loss, very strict stop loss. You don't want to put a stop loss which I have put initially, because the market have already moved a bit. When it comes down, just put a strict stop loss and then enter if you really want to enter. My
Okay.
advice would be to ignore ignore if it had already moved. But if you still want to get in, wait for my price to hit and put a strict stop loss instead of the one which I have put in.
Okay. So yeah, I mean, I think I got the answer. So second, basically, just to touch base on the stop loss, some of the positions, I think AMG, and just take recent example on Friday,
Uh-huh.
maybe that was a swing position, but then once you entered, it dropped down significantly, or maybe some other position which is already beyond your stop loss or down, but just showing again bullish signs. So is it okay to add a price which is, again, say 150 was your enterprise, 125 was the stop loss.
Mhm.
Whatever the news was, half an hour later, the position is showing bullish signs again, but at a lower price. So is it sort of okay to enter at that point in time?
Yeah, that's again a very good question. I think at that time it will depend on what's set up. Now, my idea is to enable everyone to trade without me. Basically, you should be
Mhm.
trading based on your own setup. If you think that it's showing bullish character, that's something your trading system is telling you. I honestly don't know what bullish signs are you talking about at that point in time. So if your trading system is telling that, yeah, it's showing bullish signs, you can definitely get in, and again put a stop loss just below, or a bit below it, and then enter. That being said, so the main question here would be, if my position, if I've entered at 150 and if it goes to 120, and at that time it's building a base, if a stock is building a base, is it okay if I enter back again? It is definitely okay, but again, based on your system, if your system says, if at that time the VWAP have moved down to 120, and if VWAP is showing a bounce at 120, yes, get in. So it all comes down to what your system is telling you. I post alerts based on what my system is telling me, and eventually when you guys build up your own system, if that system tells you yes, 120 is a good entry, you'll get in. But based on my system, if you're entering at 120, that is probably not valid, because from where I entered, the price have moved down, and that was my stop price. So I won't suggest entering at that time based on my system.
Okay. Yeah. Thanks. Got it.
Cool. Any other question before we move on?
Actually, I have one follow-up question to your point that you mentioned if a stock is already at its all-time high,
Mhm.
don't think that it has reached the max, so you don't
Yeah.
want to get it, right? So, what is the input or recommendation around like, or how do I figure out like, okay, though it is all-time high, I can enter that stock? Any tips around that?
Yeah, good point. So all-time highs, first of all, there are two entries. So previous all-time high, if a stock is basing just below or above the previous all-time highs, then that's a good point where you can probably get in. If it has already moved above, let's say Apple was 100, the previous all-time high was of Apple was 100. Now the price is trading at 125. And if you want to get in Apple, if it's at 125, you would want it to show some basing around 125. What I mean by basing is at lower time frames, 1 hour, 15 minutes, you want to make sure that it's basically showing some base. It has gone up to 130, let's say. It has come down to 125, and on 125, it's showing some consolidation. That's when you want to enter. Similarly, I don't know if you got a chance to look at the previous video when I mentioned that 10-day, 9-day moving average and 30-day moving average. That's one of the tool which you can use when it's trading at all-time high. When there is, when Apple goes above, let's say 100 was the previous all-time high and now it's at 125. When it comes down and retests 9-day, that's your entry. When it comes down and retests 20-day, that's your entry. I won't recommend trading if Apple trades at 125 for the first time. Don't get in at 125. Just wait for it to retest these long-term or these short-term moving averages, which holds key, which can act as support. So immediately, if it's showing all-time high, don't get in. Wait for it to base, revert to mean, as in revert to some of these moving averages, and then get in. Does that make sense?
Sorry, and when you say immediately, what do you mean by that?
Okay, so let's say yesterday Apple was trading at 100. Tomorrow Apple is trading at 125. Now you don't want to get in at 125 immediately. You want to wait for a few days. When it comes down to one of the moving averages based on your system, whether it's 9 or whether it's 20, that's when you want to get in.
Okay, thanks.
Yeah. Cool. Any other question? If not, then so trading psychology continued. Never average on a losing trade unless it is at a very strong support. Now, stay away from lotos unless you have a very good profit cushion. They seldom work. Lotos is nothing but a $50 or $100 option contract with the same day expiry, and it's basically a zero or a hero trade. Stay away from that. That's basically a gambling mindset. There is hardly any technical analysis in that. Only do it when you have a good profit cushion. I definitely not advise any one of you to do it unless you have profit cushion, because they hardly work. The next is plan the trade and then trade the plan. These two go hand in hand. Homework is very important. Have predefined levels where you want to get in and then scout for an entry. You need to spend some time post market. Half the job, most of the folks with whom I've interacted with on Twitter or somewhere else, most of the gurus, the trading is not actually the time you've spent during the market hours. It's basically post market or pre market analysis what you do. Now, of course, most of the setups might not work, but that's the hard work which you need to put in. You have to plan your trade, how you want to get in or where you want to get in. You have to predefine all the levels, and whenever you get those chance, you have to wait for your entry and just get in. Don't be afraid to pull the trigger. That's all you learn. So what I mean by this is, if a stock is showing support at a point which you've defined at a predefined levels, then don't be afraid and don't think that no, it's going to go down further. You have to pull the trigger then, and that's how you learn. Don't bet the house on a single trade, even if it looks amazing. Let's say you've based on your technical analysis and based on somebody else's you follow on Twitter, everybody says, okay, this stock is a buy, this is going to create millions. Don't ever listen to that. Even if you listen, even if you bet on that, don't bet everything on that single trade, because that's something you want to control. This, what I preach here is not a gambling mindset. It's a basic system. It's a risk management system where you'll succeed over a period of time. You don't want to become a millionaire. You don't want to have a mindset of becoming a millionaire overnight. Of course, everybody would love to have that happen, but it hardly happens in stock market. It's a marathon. I'll come to that point later in the slides as well. So try to devise a system. Here's the point regarding system. Try to devise a system and make it your own instead of trying to learn 100 different systems. What worked for others might not work for you, and vice versa. This is due to difference in personalities. Someone may be good at day trading and might not be good with swings. Try to understand what's your trading type and hone it. What I mean by this is, I might be good at day trading. I might not be good at swing trading. And similarly, one of you might be good at swings and not good at day trading. So everybody will have different systems. You need to have one of your own system instead of following anybody, even me for that matter. You need to own one of the system, try to work over it, hone it, and make it your own. And that's how you are going to succeed over time. Today I'm posting alerts. Maybe tomorrow my situation changes and I'm unable to post it. So instead of relying on any of the alerts, just try to work on one of the system and make it your own. Over a period of time, that's how you're going to succeed. Now, any questions on that? Okay. You guys are able to hear me, right? There was some connection problem earlier.
Yes, we can hear you.
Yeah, it's all fine. Yeah.
Thanks. So don't revenge trade. If you're down big for the day, best course of action is to shut down your machine and come back fresh the next day. Never have a mindset of taking revenge from markets. This happens to me often, even now. I hate to admit, but yes, that happens. If you are up for the day, especially during the morning hours, and something bad happens, you don't play the same ticker. You don't feel that you want to take the revenge from market has not taken money from you, but your system, whatever you followed, was not up to the mark. You lose primarily because of your system. One, your system is not right. Second, you are not following your system. You don't go into the mindset of taking a revenge from market. This will basically add further weakness to your portfolio. Don't do that ever. I'm sure everyone amongst us have thought about this. Whenever you buy something, the price always goes down. Be honest, I think most of us experience this, right? Whenever you buy something, the price always go down. If you follow constant process in all your trades, you will definitely succeed over time. Why we lose is because we change our process constantly and we don't follow it in all the trades we take. Think of it as sequence of trade. It's not about just one trade. You lose few battles to win the war. That's how it should be. That you want to treat trading as an outcome of multiple trades, not just one trade. And that's the reason you want to be in a position where you're not betting a house on just one trade. Market will always be there. If you're not feeling good or have other things going on, just take a break and come back fresh. Don't feel the urge to trade every day, every few days. Market will always be there. Whenever you're fresh, just come back and it will still be there. Don't repeat the mistake over and over again. It's very helpful and advisable to maintain a journal. This tells you what's working and what's not, what was different in the ones which worked. So this is, I used to do that a lot, trading, maintaining a journal. I don't do it right now just due to lack of time, but given a chance, I would definitely want to do that. It tells you what was working, why the setups which worked actually worked, and the ones which are not working, you'll clearly get to know why did it not work. I was trading a lot of SPX, SPYs, and at the end of journal, when I reviewed my journal at the end of a week or every 2 weeks, I found out, okay, the tickers which were not working was SPX and SPY. Then why do I want to trade those if it's not working? When I tweaked that thing into my trading, trading process, I immediately found that yes, the results improved. So that's how you maintaining a journal. I know it's a laborious process and nobody is fond of it, but eventually that will make you successful, because that tells you why you went into the position, what was different with the ones which worked, and then you are going to limit the ones which are not going to work. Eventually most of your trades will start working, because that's what you'll um, in the hindsight or in subconsciously you'll know, okay, this is the trade which have been working in the past and which might have high success rate. That's why you want to go in with only those trades and limit the one which was not working. Okay. If you're doing good for the day, make sure you don't lose it all by going into a gambling mindset. Again, I just want to reiterate the same point that if you're doing very good for a day or 2 days, 3 days, then don't lose it all by going into a gambling mindset. This is very important, because sometimes you feel, okay, you've gained X amount, which is very much higher than what you've initially thought. Don't bet half of it or a lot of it. 10%, 5% of it on lotos, that may be still okay. But yes, betting it all or half or even 20%, I won't recommend. Just keep what's yours, because market takes it very easily, takes it back very easily rather. Cool. Any question on that before we move to risk management? All right, let's move to risk management. So this is a very key aspect, just like the trading psychology previously. The reward in a trade is uncertain, but risk is the only thing you can control about your trade. As traders, we want to, so as traders or investor, we want to control everything, right? We want to be in a place, or we want to aim for something where we are able to control everything, but that's not the reality. You can control the reward in a way where when you book your profits, but the only thing you can't control the reward, rather you don't know how much profit you're going to get, but the only thing you can control is the risk, that how much you can lose per trade. If you're having sleepless nights over position, then the size is too big. Plenty of us, I used to do that overnight. You check the futures, you check your position, what the position is doing. You're having sleepless night, or that means you're over leveraged, or your position size is too big. If you have too many open positions and plan to carry it overnight, it's advisable to hedge. SPY puts, VXX calls, TLT calls. There are lots of hedging mechanisms which you can use. So that's definitely advisable if you have too many open positions. Now, too many is very subjective. Anybody can have different risk appetite, but I don't have exact number as to how many is too many. But if you're not able to sleep at night, if you're having restless nights, then maybe you are having too many positions, or your position size is too big. You should never be interested in someone else's trade or position size. Find your own based on your risk appetite. Basically not trade, but trade size or position size. Leverage and margins are tools which should never be misused. Always play in limits. So with margins, with options, of course, the leverage is like $100 option may turn into 1,000, 2,000. So that's a very good leverage you get. Even on margins, if you have a margin account, you have the field to bet 100K, 200K on one stock. Never ever do that. Just play in limits. Think that margins and leverage are something which can ruin all of your portfolio. So always, whenever you are betting large, think about this, that there is no coming back if you lose a lot. It's very hard to make money in market, and it's very, very easy to lose. I think most of us are already aware of that fact. That point exactly is clubbed up here. It takes just one bad trade to ruin all the hard work. You always have to stay focused. If you think, let's say in a week you've earned about 1,000, just a random number, $1,000 in a week, you've traded a lot, you've basically applied everything to the best of your knowledge, and at the end of the week on a Friday, or let's say Friday morning, you are plus 1,000. On Friday, you don't want to give all that 1,000 back. Just one bad trade can actually ruin all the hard work done during the past week or so. So you have to always stay focused. You have to always watch the market. If you can't watch, just put your stops in, and that let it work. So you don't want to ever give back your profits to the market. Of course, you have to give some because you're stopped out, and that's the risk in this business. But because of your error, you don't want to give anything back to the market. Any questions on that?
How does this change in terms of long-term investment?
Yeah, that's a good question. So in the long-term investment, now long-term can be 2 years, 5 years, 20 years. It depends on what your long-term criteria is. Now, if you've entered a stock, let's say Apple at $50, and you want to keep it for 10 years, in that case, I don't recommend adding any stops to that, because it just doesn't make sense. Then if you want to invest, if your long term is for 2 years, maybe at that time you want to put a stop loss at around 30 or 35. I don't have an exact percentage where you want to put your stop loss. It depends on person to person, but I would advise you to put stop on anything which is less than 5 years, because you want to, market corrects, like there is steep correction every, I won't say a 20 or 30% correction, but there is at least a 10-15% correction every 2 to 3 years. So at that time, you can probably get in if you really want to get in. So for 2 years, 3 years, or 4 years, I would advise to put a stop, which doesn't have to be very aggressive. It can be conservative only because of the fact that if there is a flash crash, or if there is any kind of crash, you are prevented against that. So long term, of course, the stop criteria does change, but I would still urge everybody to put stops in place. And worst case, if it stops you out, and if it starts to go up, you can definitely get back in. There is no harm in getting back in. Stop should be treated as something which is part of your trading system. If you're stopped out, no harm. If tomorrow or next day, if the stock is showing bullish character, you can jump back in, and that's fine.
Yeah, that makes sense. Thank you.
Sure. Any other question on this?
Yes, Arthak. So I would like to ask one thing, like booking profits or like exit point. And like say, for example, I have a couple of positions. I may want to exit one at a decent, whatever, say $20 plus than what I bought, and then wait for maybe the other one. So how you sort of decide on the exit, when to exit?
Yeah, I do have something in the upcoming slides. I'll touch upon
Okay,
that.
sure.
Cool.
Thanks.
All right, let's move on. So yeah, risk management. So yes, this is a very important aspect. Ideally, each position should be a fixed pre-decided dollar amount. I get this question a lot, that how much you are investing per position. I honestly, the answer to that should be, it should not matter to you. You should define how much of a dollar amount each position you want to get in. Now, basically, this is an example. Let's do a working example here. Let's take a working example. Now, each position, let's say you've decided 1K, you've decided that you're going to take each position, which is worth 1K. Now, the JP Morgan one call costs $1. An Apple call at that time costs 3.3 per contract. Then you should ideally take 10 contracts of JPM and 3 contracts of Apple. You should not, what I mean is, if per position, if you have allotted that you're going to take $1,000, then 10 JPM contracts or 3 Apple contracts, because of the fact that this ensures that you have consistent position sizing and removes emotion while putting on a trade. Very many times you felt that, okay, when you're putting in an order, you might feel, okay, let's do 2, let's do 5, let's do 10. On what basis do you decide that, right? If a call feels cheap, you might take larger number of contracts, but if it feels expensive, you just might take 1 or 2 contracts. But you should define how much dollars per position you should take, and that reduces by a lot the emotion emotion behind putting on a trade. You'll definitely, I know by reading this, it might not make sense, but whenever you trade next time, if you allocate a position size, a dollar amount per position size, this will definitely help you in maintaining consistency. Now think in terms of percentages. So 1 to 1.0 move, basically 1.1 move, is same as 3.3 to 3.65. This is basically 10% move. Now, if you take the same number of contracts, let's say you take 2 contracts of JPM or 2 contracts of Apple, then with a 10% increase with JPM, you only get $40 of profit. With Apple, you get $70 of profit. Now, if you fix the dollar amount, 1,000 in this case, then you'll end up making or losing the same amount. Now, why this is important is because $40, maybe $40 is not, of course, 40 is not greater than 70. So you might want to push your limits 1.1. If you might not want to book your profit at 1.1, you'll wait for it to hit 1.15 or 1.2 to get that $70 what you wanted out of Apple or what you've seen out of Apple. So at that point in time, if the move is not there, you'll probably be losing, or you'll basically not be booking at 1.10. You'll be waiting for 120. 120 will not happen. It will go back to 1, and you are out with nothing. You are basically you're out at break even. So to reduce that, if you maintain consistency in your process and the trading position, it will help you out in the long run. This small tweak, just see the small tweak will help you very much in the long run. Don't lose more than X percentage of 1K in the example above per position you want to put on. So basically, you define that 1K per position. Now you have to define X percentage. You don't want to lose $200 of each position, or $300 or whatever you want, like 30% or whatever you want to put in, because that will ensure that you are honoring stops and not losing 100% of your investment on one position. Now, similarly, don't lose more than X percentage of your total account size in one day. Let's say your account size is 100K. You don't want to take 10 position, 20, or let's say 50 positions in a day. That will actually be equal to 50K worth of investment in a day. And let's say everything goes against you. You eventually end up losing 10K or 20K based on the X, of course. So you don't want to lose more than when you define your system, take these things into criteria. Like, I don't want to lose $200 per position of 1K size. Similarly, I don't want to lose 10,000 or 10K dollars or $10,000 from my 100K investment of my total account size. I'll share these slides or video with you. Just go over this, and it will take time to digest. Any questions on this?
I may not be on this, but I think a couple of questions posted on the chat in general.
Okay, so I'll get to those later. So always book partial profits on the way up. You'll never get broke by booking profits. This is a very important aspect. Just keep booking partial profits. I get a lot of questions in the chat and in the personal window as well, that, okay, this one is up this much. Should I book it or should I just wait? There's no harm in booking partial profits. If you would have seen, I always mention in the chat, okay, book half, keep half. Majorly, just try to book partial profit, because small profits do add up, and you are never going to go broke by not booking profits or by booking profits. Trading is a marathon, not a sprint. So each trade adds up, and eventually it's a marathon. You're not running a 100-meter here. It's basically a marathon. And that's why I emphasize around series of trades. It's not just one trade. You don't want to bet a house in one trade. You want to keep your position size constant. And that's how you eventually devise your system. And eventually that's how you participate in that marathon. As a new trader, your main focus should be to protect capital and maintain discipline. This is the meat, that as a new trader, your focus should not be X percentage of gains or Y percentage of gains. It should primarily be protection of capital and maintain discipline. I would tell you my experience, my first few years, down. Then eventually there came a couple of years where I was just breaking even. And then after that, there comes a time in trader's career, then the profits start to come. That's exactly how it should be. And that's what I'm trying to limit here, or that's what I'm trying to educate here. That you don't want to be a trader where everything is going down. You don't want to focus on just the profits. You want to focus on risk management, maintaining discipline and protection of capital. The sooner you start doing that, the results will automatically follow. And that's something which will come over time. I know just by reading this line, not many of you will start following it, but eventually when you start to work on your system and when you start to follow that system, the results will automatically follow. Now, what's discipline? All the things which I've previously mentioned. It's about respecting stops, don't over leverage, don't trade on FOMOs, don't trade on tips without understanding the reason behind trade. Stop trading during choppy markets because you'll be stopping out a lot. Ride the wave, keep booking profits on the way up. Don't average down on a losing trade. Define a system and follow it all the time. This all the time is very important, because if you define a system and only follow it for one trade and not follow it for the other, of course, the other one is going to take all the gains from all the other ones where you didn't follow. And that's why it's very important to follow it always. Okay. Any questions on risk management?
Well, can you explain what is a choppy market, please?
Sure. So it depends on, choppy market is basically, it depends on your criteria, as in your time frame. If it's hourly, monthly, daily. What I mean by choppy markets is, I would have loved to show you a chart. Okay, let me take this question and I'll show you a chart at the end when I'm done with the presentation. Then
Okay, I have one. Yeah, sure. One more question. So you talked about taking partial profits, right?
Yeah.
How about taking partial losses? What is your opinion on that?
Oh, that's interesting. I will definitely not recommend taking partial losses as well. Eventually, let's say your position is going sour and you're putting your stop loss at three or four places, depending on what your position size is. So eventually, if you lose it all, if your last stop loss is also hit, you're going to lose out a big, unless you're suggesting that, let's say you want to lose just 1% of the position which you've put in, and you are trying to put a stop loss, very strict stop loss, and then work your way back. I honestly don't advise putting a stop loss on a partial loss. That being said, if let's say I have 10 contracts, I put 5 contracts, or I put a stop loss on 5 contracts, not at the same point, but somewhere nearby. The reason I do that is because of the stop hunts. There are times where algos just look for stops, they stop you out, and it comes back up. So I try to put my stops not at the same point, but tearing it down. But that being said, that the original stop level still holds true. So I'll put 1 or 2 stops over it, not below it.
Okay. Okay.
All right. Let's move on to just some random tips. I didn't know which section it belongs to, so I just created a random tip section. This round numbers matters a lot, like 50, 100, 200, 300, 500, 1,000. Whenever a stock is trading near those levels, there is bound to be some action. Example being, play a momentum stock if a momentum stock is at 98.5, you can play it till 100 or just under 100 and get out. I do that a lot. Like I think SQ, when it was below 100, when it was at 98.5 or somewhere between 98 or 100, I just buy it and sell it before it hit hundreds, because it's an immediate support or resistance level depending on where the stock is. So round numbers in trading, they do matter. You would want to, if you are in a position, let's say from $90, and if it's approaching 100, you might want to limit your exposure. Even if you don't see any immediate resistance, just the fact that it's approaching 100, you might want to reduce your position at that time, or hedge or buy puts just for short term to see how it reacts at 100. So you can back test this one, whatever stock is between. I have a scanner which I want to play more, but I don't get a chance. But I have a scanner. Give me all the stocks which are trading between 98 or 101. I want to basically play those. I don't get a chance a lot to play those, but this is something which just you want to keep in mind, that round numbers do matter whenever you are in a position or you want to take a new position. Now, think of options DK before earnings or news event before taking on a position. So I've seen many folks, I know some of you are already aware of this, but I just wanted to touch upon this, that if there is a earning, let's say there is earnings for Apple tomorrow, you don't want to take a position, a call option just before earnings, because of the DK IV crush. It depends on the stock, but there is an IV crush post earnings on all the stocks. So you don't want to buy a put or a call just before the earnings. The best way is to play a post earning trade. They are better than holding any option or stock into earnings, unless it's a long term hold, because at that time all the premium have been sucked up or sucked out, and at that time you are in a better position and you know which way the trade is going, if the earnings were good or bad, and where the stock is. Similarly, red to green moves are very bullish. So RG is red to green. If in a day you see a stock move down a lot and it has started to move up, or it has gone green, those are very bullish moves. And similarly, green to red are bearish. Take notice of green stocks on a red day and red stocks on a green day, and make a note. They will emerge as leaders when the market changes direction. So this is relative strength and relative weakness, which I try to talk about during the sessions or during the trading hours. Now, always try to buy near support and sell near resistance. Avoid range plays, as your stops would be very wide. Are you guys able to see an arrow over here?
Yes, we can.
A green arrow?
Yes.
Oh, don't know where that is coming from. Okay, never mind. So take notice of green to star. They will emerge. Always try to buy near support and sell near resistance. Avoid range plays, as your stop would be very wide. Yeah. So what I would suggest is always buy near support and sell near resistance. You don't want to be chopped out, or you don't want to play any range. Why? Because your stops, you won't know, your stops would be very wide. And basically, if you want to get in a position, let's say Apple's immediate support is 90 and resistance is 100. You don't want to get an Apple at 95, because you don't know if it's going to 100 or 90. You want to play closer to 91, 92 if you want to go long, and if you want to go short, you want to play closer to 98 or 100. Always try to only get into A plus setups, which has high probability of success. Avoid secondary setups and you will see your results increase. So what is meant by A plus setups? It will, of course, based on your trading system or what you've devised. But I would say that I had multiple setups. I used to get into multiple setups, and I knew before entering a position that this is not a high probability setup. I just went in probably because of FOMO, or I felt that this will be a good trade. But stop that urge. Only in the back of our mind, we know that some of the setups looks really good. It will come over time, but some of the setups are showing A plus character. Like it is bound to go high. Only try to get in those. You don't want to invest in a stock which is not showing A plus setup. It's basically as simple as, if you're running a business, you don't want a subpar or a suboptimum service. You always want to be at a point where you are taking the best quality. So that's what I mean by A plus setups. Don't put stops on round numbers or obvious points. Keep it a bit lower for longs and higher for shorts. Algos often do a stop hunt and reverse immediately after. Positive mindset matters while trading. It gives you better decisions and less errors. So this is very important. If you're feeling negative, or if something has distracted you from trading well, or your mindset is not right, just take a break, because positive mindset results in better decisions and less errors. Don't trade on your feelings. This is very important. Markets have gone too high, it will pull back up. Markets can remain irrational longer than you can remain solvent. You must have read it plenty of places. So this is basically, don't trade on your feelings. You feel that market is going up tomorrow, I need to buy puts. Don't do that. If you're set up, if it's coming off of resistance, yes, you can. But just on the feelings, don't play that. So when you enter a trade, this is what is recommended. Put a stop. If your position moves up, change stop to break even. Sorry. If the position moves up further, move stops further up. This is how you'll end up booking constant profit and don't end up red on a winning trade. So that you must have seen, this is what I do in the trading room. If a position is moving up, I can immediately change my stops to break even. Then if it moves further up, then I move the stops further up, so that you're basically constantly moving profit. This third step, I don't always follow, but this is something we should. This is basically trailing stops. You're constantly moving your stops up so that you are able to book a good amount of profit when it's going in your favor. Now, I think one of you asked about when to book profits. So there are a few places where you can book profits. If a trade is approaching resistance, or you can predefine a fixed dollar amount. Let's say you've invested 500 in a trade. If it goes to 700, you can probably book then. If it goes to 800, you can book then. That's something which you need to define. And then fix percentage amount per trade. You want to, if you're getting 20% out of the trade, you are getting out. When I say getting out, don't get out completely. You can probably use this layering mechanism to get out. But what I use the first 2 points majorly. If I see it's approaching resistance, I cut down my position. If it's approaching resistance, I'll probably move everything, as in I will not even raise the stops. I'll just get out of it. If it moves up and I don't see a resistance, immediate resistance approaching, then I'll probably fix a dollar amount. Okay, if I've invested 500, if I got 700 out of it, I'll just start raising my stops. So that's how I book profits. Any questions on these random tips? If not, then yeah, that's pretty much it. I can open it up for general questions. I know one of you mentioned that there is something in the chat. Let me. Can one of you read? I can't see the chat somehow. Okay. How much is your position size for one trade? Is 5% of an account a decent size for one trade? So yeah, that is a good question. I think I honestly don't have a percentage which I can recommend. It depends on your risk size. I would encourage, you can probably watch some of the YouTube videos to trim or to make it to your needs. I don't have a recommendation of what is your position size. I believe 5% is something which is a decent size for one trade. But what I've seen with day traders, it's usually 1% of their whole account size. 5% is a bit much. Yeah. What if your stop loss never kicked and you are the swing trade? Next day it gaps down so much. Do you cut loss or wait for? Yeah, that's a very good question. So yes, as soon as it gaps down against you, you just if it is below your stop loss, you just get out. And if it starts to move up, you will probably get a better value. You can then reevaluate if you want to get in. But the best way is to get out immediately if it goes below your resistance or below your support. Cool. Any?
And sorry, and that's true even if it is a long-term investment.
Oh yes. Stops is so long-term investment. Again, I'll reiterate, for long-term investments, what you are doing is you are definitely setting a stop, but your stops might be not that aggressive, might be conservative. So for $100 stock, maybe your stops are at 75 or 80. But in this situation, yeah, if it's a gap down, you should definitely stop out of that long-term holding as well. That's what I would suggest.
Okay, thanks.
Cool. Any other question? I mean, you don't have to ask question based on the slides which I've mentioned. You can feel free. I think we have about 20 minutes.
So, Sathak, one question I can think of, if more of it falls under the previous, I think, technical analysis, but you mentioned setup like few times and VWAP rebounces maybe as an example. So, like if you have to think of like couple of different setups which work the best for you on your personal experience? What those will be?
Yeah, a good question. So I can actually show you my trading setup. I wanted to cover this in one of the other sessions, but okay. I'll maybe cover it right now as well. Are you able to see my trading platform?
Yes.
Okay. Are you able to see Netflix here?
Yes.
Okay, cool. So this is my trading set. This is just one of the windows. I have three similar windows like this. So there is, now it's very hard. I can probably take a session on what I look for, but what I would say is if there is a bounce, one of the key setups which I take is, let me maximize one of them. One of the key setups which I would like to take is if it tests previous day high or low. Yeah, this one. So this green line is previous day high. Now here, if it's testing previous day high, and this is the green one is the Bollinger Band. So if it's outside of Bollinger Band and testing previous day high, this is where I'll probably go short. This is one of the setups which I take. And I like this one a lot. And similarly here, VWAP rejection. This is, so I need to, I'll probably take a session on this. I'll exactly tell what is my setup. But this here, this is a gray line is the VWAP. And if you see here, this VWAP, it tries to go up and down. I think I covered it last time, but just to reiterate, this is one of the setup that like VWAP rejection is what I take. Now, of course, just blindly based on this VWAP, I won't take it. I'll see that it has been rejected from one of my moving averages as well. So this is in conjunction with VWAP rejection. So unless it tells me 2 or 3 setups together, or if it tells me, if it should show a confluence of multiple criteria. If you see here, this is a very good example. This one, the rejection from previous day high and outside of Bollinger Band. And if you see, this is RSI, this is oversold. This is 5-minute chart, by the way. So this fulfills 3 of my criteria. Like RSI is oversold or overbought. This is previous day high, and it is outside of Bollinger Band. So I think this is a very high probability setup because of the fact that 2 or 3 criteria are being met here. Similarly, previous day low, I don't know, this is not showing previous day low. Yeah, this one, this is SPY. This tested, so this red line is previous day low. This tested previous day low and it just went up. It never retested this. So one of this setup is previous day low. Now, of course, this is, there's not just one setup which I look for. I would see where the other stocks are. I don't want to get into that right now, but to your question, these are kind of setups which are previous day high bounce, previous day high rejection, previous day low bounce or rejection in conjugation with some of RSIs or VWAP. Let's say for a previous day low, we were able to get a VWAP over here, or there was a VWAP of just right here. Then that would have been added benefit or added criteria for me to get in that position because there is a VWAP bounce plus a previous day low bounce. So adding 2 or 3 criteria makes it even better, in my opinion. So one of the question was, I think, regarding choppy markets, right? Are you guys able to see Chrome?
Yeah.
You can see now SPX.
So this is on a daily chart. This is a trending market. If you see from here to here, this trend. Of course, in the middle you get choppy zones as well. That's why I mentioned that it depends on your time frame. But if you see just this section, if you see just this section, it goes down, up, down, up. It's basically chopping. It depends on your time frame back. I'm reiterating that, but this is chopping. So this is what a choppy market is. It goes down. It is undecided. It's a hammer. Then it goes up. then goes up, consolidates here, it's chopping around. It doesn't have a direction, clear direction. Then again goes down. Then once it breaks it, it goes, at least it trends for a few days. Then it bases, now it's trending for a few days. So this is a choppy market versus these one here, a trending market.
So can we say choppy market is more of like a lot of sideways movement
Oh yeah.
in simple terms?
Exactly. Choppy is equal to sideways, yes.
Okay.
And most of the time you'll encounter a choppy market. It's very few times you'll see a trending market, and that's, some people are good at choppy markets because they sell premiums. In options you can sell or buy, they sell premiums and they like choppy markets. But if you are a buyer of an option, you would like a trending market because that's when your premiums gets elevated. So it depends on how you trade or what your trading perspective is. Cool. Any other questions? Okay, if not, next time I'm thinking of creating, basically, how do I prepare for the market? Like what scanners I use and how do I create a watch list? I know I get this question asked a lot of times, so I'll probably do a session. I have shared some of my scanners in the FAQ sections, but what I'll do is I'll look at those scanners during that session, during the next session, and show you guys what I look for and how I prepare the symbols or what to look for in the next stage market. Some of my symbols are, as in, I've already, like FB, Google Fangs, all of them are already there. I just always look for them. But some of them I do a homework and prepare a list. So those are the ones which I'll show you how I prepare those lists and look for that. Okay. Cool. Any other question? If not, then I can give you back 15 minutes or 14 now.
This is a very helpful. Yeah, so just looking forward to the next session. Yeah, thank you for sharing this.
Cool. Yeah, thanks, guys. I get a session on your trading strategy, example Viva strategy. Okay, so what I'll do is I'll probably take a poll on the Discord channel itself and see what everyone's is interested in, and then based on public demand, I'll schedule the next session. I'll schedule the topic for the next session then. Cool. All right, guys. Thank you so much for bearing with me. I'll upload this as soon as it's uploaded to YouTube.
Sure. Yep. Thanks. Thanks for taking the
Thanks a
session
lot,
and
Satvik.
as usual
Very
answering
helpful.
questions.
Yeah. Thanks, guys. Have a good
Thanks,
day.
Satvik.
Thank you. Bye.